You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing,
Hello, I'm Deidre Willard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. So here's the thing about real estate investing. It costs money. So most of us probably started out using our own capital, and that's usually the right way to go to start. But if you're going to scale and you want to grow big, you probably are going to have to use someone else's money at some point, which I think for a lot of us ends up being a little bit of a hurdle to kind of get us beyond that. I'm here with Matt Faircloth, who's the author of Raising Private Capital. He's also the co-founder and president of the DeRosa Group, which owns residential and commercial real estate around the U.S., and they've done over $30 million in transactions, and he's had to ask other people for money, so he's a great person to talk to. Welcome.
Deidre, thank you so much. That was a great intro, and it's such an honor to be here.
Well, let's start because the book is called Raising Private Capital. What exactly is private capital?
That's such a great question. And I got to tell you, I've never been asked that because people assume that folks understand what that means. And I think a lot of real estate investors might misunderstand it because it's not hard money. It's not, call it institutional capital or family office or things like that. Private capital, as I define it in Raising Private Capital, is money from people that may be in your own network, but it is money that comes from individuals, as I define it in the book. And that money could be used as a loan in my business to help me bridge a property from dilapidated condition up until it's to bring it to its highest and best use, or it could be equity that wants to ride along and win alongside me on a rental project, whatever that may be, that wants to co-own something in a passive position. So I define private capital to be money that comes from an individual that's partnering with me or lending to me on one of my projects. And I lovingly call it in Raising Private Capital, I call it the cash provider, because we provide the deal, they provide the cash. So deal provider, cash provider.
Which I think is a nice, easy way to think about it. I think I like that in the book. It made it very clear, and it also defines responsibility, which I think is something that gets a little blurry, and we'll talk about that a little bit later. So let's start with how you begin. Most of us, we go to family. Sometimes I've heard horror stories. I'm sure you've heard horror stories, but you did this, and it worked out for you. What's the secret?
I did. I just got lucky, Deidre. That's it. No, I'm kidding. It's totally not. I think that the secret is that that whether it is, I mean, my own mama is a lender on some of our properties, right? So, but I don't treat her any different than I would anybody else. And the horror stories that you've heard are people like, well, it's just my sister, or it's just my cousin, or it's just fill in the blank. That person that I have other relationships with, be that a friend, a cousin, somebody I went to high school with, my next door neighbor, somebody from my church, whatever. These are people that we sometimes encounter during walks of life, and eventually people that you don't know that are approaching you because of your track record. But the secret that I've always done is you treat everybody equally, and you don't treat my mom any more or less, or just, my mom's just lending me some money, let me not give her a loan agreement, or let me not do the proper documentation or things like that. So we've done deals with relatives and friends and people I went to high school with, and all those folks, among many others now. But we treat them all the same. They all sign the same loan agreements. They all trying to sign the same things. We pay them the same terms, and I think that is the secret, in that you just have to establish a protocol and treat what you're doing as if you are a custodian of their capital, because you are, regardless of who they are, and treat them the same as you would anybody else. And I think that's one of the keys to success in this thing.
I would absolutely agree with that. I think one of the things that when I hear these horror stories, it's usually like, there was like no agreement. There was no, there wasn't even any kind of contract. It was just like, oh yeah, I'll let you this money, and then I'll give it back in a certain amount of time. But then it just, it didn't work out. So I think it's really important to treat anytime there's money involved with family or friends or anybody, contracts are good. Contracts are important.
Yeah, and then a handshake is great, but you follow that. In the other hand, you should have a pen and a piece of paper
Exactly.
for someone to sign.
Well, let's talk about using your network. You mentioned like people you went to high school, things like that. I used to train real estate agents, and I would talk to them about their networks, the parents they met at their kids' school, all that kind of stuff. Beginning agents get really uncomfortable with that, and I think that's true if you're an investor too, and you're trying to raise capital. How you go from we're friends and we talk about things to you should know that this is a thing I do, and here's how you can get in on it. How do you make that bridge?
It's funny. The first thing you could do, and this is like when you first get started, people ask you questions when you go to the cocktail party, the backyard barbecue, the whatever. You start talking about work, like so people, what else? You either talk about your kids or your work. That's it, And so it might be tempting to talk about your day job and maybe how you don't like it and how you want to transition out of it, but it's actually more lucrative for you to tell people in your network about your very exciting real estate investing business. Not from a perspective of, hey, you could lend me money, It's just, hey, I really am loving this Million Acres podcast, and I really love the show, and it's so great. And you know what I learned? Did you know there's this thing called a 1031 exchange that one of their guests talked about? Or did you know that there's a da-da-da-da? So you start to share what either you're learning or what you're experiencing with people around you. And there is a reason why, shows like, Flip That House or Flip or Flop or whatever it is you want to say. There's a reason a lot of people watch those shows. It's because real estate is interesting. We all experience real estate. You and I are both sitting in real estate right now. So everyone is familiar with it, either as a investment vehicle or as something, And so people can relate to it and they find real estate investing interesting. And so they'll typically ask questions like, oh, real estate investing. So that's what you do, is it? So they're like, so you're buying apartment buildings? Well, no, we're going to start with single family homes and we're going to scale up to apartment buildings. It's really great. So you just make people aware of what it is that you do. And when eventually people will say, well, geez, that must cost a lot of money. It does, but I've read this awesome book by Matt Faircloth called Raising Private Capital, and it's told me about how I can get people in my network. And you don't close, you inform. The best capital raisers are simply educators. They're not good salespeople, they're just good teachers. Right. And so you've got to just teach people, because the majority of America, Deidre, believe that you either can't or that it's illegal to invest with your retirement account in real estate, because only like 3% of the retirement accounts in America are invested in something outside of Wall Street. So most people just don't want to do it or don't think you can do it. So there's a lot of education you have to give people and teaching them how to do these things. So I find that it's best to just educate your network and tell them how exciting it is. And eventually they'll say, why don't you come over for coffee next week and tell me more about that? That's how we got going, was not by soliciting, by just mentioning what we do. And then some days people say the magic words, which is, man, I sure would wish I could do that too. I just don't have the time. And those are the words of a cash provider, because the deal provider has time. The deal provider has resources, time, network, opportunities. The cash provider has cash, but very little time, very little opportunities, very little resources, and they kind of feel stuck because they don't want to just put another dollar into Wall Street. Maybe they're already exposed to that. They want to put it in something else. And the cash provider, through the marriage of their time, resources, knowledge, network, and the cash provider's time, those two things married together make a phenomenal combo. But it's education that creates that bridge.
Do you find that people kind of have to practice that a little bit, kind of like an elevator pitch? Do you find that you have to kind of work with it in order to be able to kind of say that fluidly and not have it sound salesy?
Yeah, well, you do, and because you got to make it sound authentic, right? And you don't want it to be. I don't suggest people rehearse. I suggest people just learn enough about it to where you can be comfortable speaking about it, and then speak from your heart. Because I find that anybody can always see a sales pitch coming down Broadway, and we've all bought a car, and it's like, oh boy, here comes the car sales pitch. Here we go, And now we're throwing in the undercoating, right? And that, right? So nobody wants that, right? But what we do want is we all want something different. We all want to hear about something new, and we're all curious. And so I think if you're prepared to just go in and just teach and not, well, I happen to have another $100,000 left in this deal if you want to hear more about it. Unless people ask, don't bring it up. And so just educate and have the courage to just stop there. So I think that just by talking about it more frequently, that comes up. I mean, and you got to find a way to say what you want to say in a tight fashion. So you could say shtick lines like, well, what do you do for a living? Well, I'm a school teacher. What do you do for a living? Oh, well, I, buy rental properties and, fix and flip properties using other people's capital, or I help people invest in real estate without any time. I'll help people invest in real estate without dealing with leaky toilets or bad tenants. You can compartmentalize it, but those things I think are less authentic than just, I buy apartment buildings, I flip houses. That's what I do. It kind of sounds like a pickup line, when you do the elevator pitch,
Well, I think the
Yeah.
enthusiasm and the passion are kind of what make it genuine.
Yeah. That's the best because people want to be excited. If you're excited, they'll be excited. That's great. I love your man. You sound excited. I want to be excited too. Let's do tell me more about it. Yeah.
Exactly. So I think one of the things that people they get excited about anybody wanting to give them money that they don't necessarily vet the other side of it. So one of the things you talk about in the book too is that idea of they're vetting you, but you have to vet them too and make sure that they're the right partner. Not any cash provider is the right provider, right?
Yes, that's correct. And I've worked with cash providers that really should have been deal providers. They really just want to be active and they want to. There's a lack, and it really. Here's, what it is, Deidre. I'll bottom line it for you. The problem that you have, if your cash provider has a lack of trust for you or views their position in the arrangement as better than, greater than, or having a leverage over you, don't do the deal. Meaning the deal provider and cash provider should be equal. They are. And I think that there's a lot of people that don't view it that way. And if they don't, then if they view their position to be more important than yours is, forget it. I move on. It should be a pari passu marriage, hand in hand. I bring the deal, opportunities, time, and resources. You bring the capital, this is how we go. If they start asking questions, that are about like, well, I want to see this, I want to see that. And, I want ratchet clauses, meaning like my interest rate goes up for every month you don't pay me or whatever. There's just a lack of trust. And then it's okay for people to do due diligence and vet you, but you can start to smell when somebody doesn't trust you, can't you? You can starts to seem like, you know what, this isn't going to work out. And I've done deals with people that I should have found another lender or another equity provider on because it was clear in the beginning that they either weren't sure what they're getting themselves into, that they got in half blind, or that they got in without trust. And these are two problems that showed up later down the road.
I think the idea of trust is important and also the idea of making sure they know what they're getting into. I think a lot of times where that lack of trust can come from is not understanding what they're doing, how long their money is going to be tied up. How do you kind of make sure that they really understand what they're doing?
Well, you got to put it in writing. Typically, we'll do for an equity position, which that's primarily what we do now. We primarily do equity positions in multifamily assets, so apartment buildings, bigger stuff and everything like that. Because we've grown through several different milestones in the business, and we got started doing, very small loans and small equity positions. So we've grown into larger stuff. But for the larger deals that we've done, and we've not always done it perfect. We still kind of learned on the job in a lot of ways. But on the larger deals, we tend to put all the terms that need to be understood: timeline, rate of return, what ifs and risk factors and things like that. We tend to put them into like a quick term sheet or a one pager, that kind of thing. Things that's really important for them to know. How long is it going to take for them to get your money back? Those kinds of things. It's not buried in 40 pages worth of information. It's right there on the front page. And that for them to be on the same page on.
Earlier, you mentioned that only around 3% of people are using IRAs to invest in real estate. Wanted to talk to you about SDIRAs, self-directed IRAs. In real estate crowdfunding, I've seen some sponsors, they don't want to mess with SDIRA capital. In the book, you sounded like you are a big fan of SDIRA capital. So why is that?
I'll tell you why. It is the mission of my company to make what we do accessible to everyone. Right? That's one of our missions. The true mission of DeRosa Group, my company, is to transform lives through real estate. I don't want to just transform lives for the super duper wealthy. I can help them too, and we do help them, and because they're already aware of what it is that we do, and they don't really need as much education because they already know that real estate and sticks and bricks is a great place to grow and hold wealth. Right now, beyond that, the very wealthy hold a lot of their wealth in cash. And that's a good thing because they can leverage tax benefits, they can leverage rates of return and compound returns, and then take the money out and do cool things with it and things like that. Middle America holds the majority of their wealth in their retirement account and their home, those two places. So if I want to make what I do available to everybody, I need to become really good at helping people access their retirement accounts and put it somewhere else outside of Wall Street. Not that they shouldn't have any money there, but they should have alternatives as well. So that's why I believe that it's a great resource, and it is such an underutilized resource. Additionally, people say real estate has lots of benefits, including tax benefits, which it does. It has great tax leverage. It has income tax benefits and things like that until you sell it. And then when you sell it, you got to pay the piper and recapture all those things, right? And there is 1031s, but you can't do a 1031 through a limited partner investment. If you are an investment in a little tiny slice of a big apartment building, unless every investor wants to do a 1031 exchange, you can't do that. So you're going to have to pay capital gains tax, and those taxes are increasing. And so how great would it be to hold that apartment building in a tax vehicle, such as an IRA or something like that? So I think that IRAs are great vehicles for people to do passive real estate investing. It just takes a little bit of education because a lot of folks in America don't realize that they can truly put their IRA account, not their 401k just yet, but their IRA account can go into alternatives, just such as real estate equity.
Yeah, I agree with that it's something that people miss out on. I think one of the things that we've learned with Mogul, our premium service, we've got crowdfunding deals that are realized, and then people want a 1031. It's like, no, you're an LP. You can't do that. That's why the SDIRA capital is such a great idea. Why do you think most people don't know about it? Is it lack of awareness? Is it the fact that there's the extra step with the custodian? What do you think it is that kind of is the blocker there?
I'll tell you, and now we're going to get real. Okay, it's because there's nobody the financial planners are not paid to tell them about that, right? Because financial planners that teach that are presenting the original 401k, or that they're assembling the 401k program that was originally, and just let's go back further, a little bit of education. An IRA is a former 401k. Some like Joe Smith or Jane Smith that used to work in one job had a 401k because they worked for a great employer that had a retirement program. Then they left and went to another job. The 401k that Joe or Jane Smith used to have at job one is now qualified to be an IRA. All an IRA is a retirement account for a company you used to work for, right? So there are financial planners that will gladly manage that IRA for you, but they will not tell you that you can put it into things outside of the Wall Street. And I've had financial planners tell their clients that it's not legal to put it into things outside of Wall Street, or that you have to run it through. Now, they're misspoken. They don't know. I'm sure it's because they just don't have the education to understand that you can't do that. That's not true. But a lot of folks just don't realize that they can put it into things outside of Wall Street. And you know what else? If you don't have something in front of you, you don't think about it. And so a lot of people forget that their IRA is there. I get so many phone calls, Deidre, from investors that are like, well, I want to put some money into your investments. I have $50K that I've saved up that I want to put into an alternative, and I want to make some great cash flow from an apartment building. And I say, great. Okay. Tell me what else. Tell me, because I look at big picture. Tell me what else you have. Equity in your home. Tell me all about your lifestyle. Tell me when you want to retire. Tell me the whole story. How old are your kids? The whole shooting match. And by the way, how much is your retirement account? Oh, my retirement, my 401k, I can't do anything with that. But I said, no, your IRA. Oh, yeah, I do have that one from that last job. Let me look. Oh, yeah, you know what? There's $300,000 in that, And it's just sitting there in like mutual funds and everything. And, what is it going to go up or down tomorrow? I'm not sure. Who knows? And so I've been able to help people unlock that capital they forget about because it's not in front of them, right? Because they're not doing anything with it. It just kind of is on autopilot mode, just sitting over there, with that custodian that's making fees for managing it for them, but they're not growing it for them. It's just kind of sitting there maintaining. So I think it's just because there's no one screaming at them and telling them that, and the people that they have asked about it have told them that, no, this is what you can do, or you can buy a REIT, in that, but that's different, very different than a private placement syndication.
Absolutely. So you talked about IRAs. The other source of wealth that you mentioned is people's equity in their homes. And right now is an interesting time because there's, home prices keep going up. So many people have so much equity in their homes. Because home prices are high, they're not really thinking of moving or doing anything like that. How can people tap into that safely? And what is your advice on using your home equity?
Yeah, you got to be careful, right? Because now we're talking about the roof over our heads and the place we raise our children in and everything like that. So you got to be careful. We're not. You don't want to put it in anything speculative or, go put a HELOC on your house and go buy some Bitcoin with it or something like that.
Oh,
you want to, yeah, right. But what I have done in the past, and me and my wife, Liz, do this now. We have a HELOC on our home. The home I'm sitting in right now has a home equity line of credit on it. And I've taken that HELOC that cost me like 3.5%. Okay. I have that money right now into a private loan at 12%. Right. So I'm making what they call, to talk, fancy talk. We're making a yield spread of 8.5% on that money. So I do not recommend that unless you're investing in a syndication deal that has a preferred return that's going to start producing immediately, and a lot of syndication deals don't right now. But if the syndicator that you're working with is going to start paying you soon after closing, like, inside the first quarter of closing, then you can do it that way. But understand, there is no guarantee. And there is no collateral that you have in a syndication. It's just you're buying equity, and it's just like buying shares of Microsoft stock. And if it produces a dividend, great, we win. But the syndicator certainly has the right to not pay a dividend. They are not obligated to pay that to you. That's just money that the deal will pay you at some point, and it's a return on your money you're supposed to make, but it doesn't have to give it to you every quarter. So what I've seen people do is to put that HELOC on their home, and they invest it in something that might not cash flow, and then that investor then has to bear the burden of that interest until the investment starts producing, which is no fun. So I want people to have positive, I don't like people writing checks hoping that the investment's going to start producing, and that's a negative cash flow position, which I don't like. So I'd rather see people either lend the money, which is what I do, or they can invest in a syndication where there is I hate to use, you can't really use the G word, but the guarantee, a regular production rate coming out of the investment. So even if it's something that on paper says that it's going to produce a nice return in the first year, it's a good place for a home equity line of credit. But just do not forget that no matter what, you have to make that monthly payment. You can't just call your bank and say, well, my syndicator didn't pay me this quarter. Can I get a do-over for next quarter? No, you can't do that. Yeah.
All right. That's awesome. Let's take a quick break here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
Some of our listeners are undoubtedly among the fortunate group sitting on piles of valuable tech stock. If you're one of them, listen up. Urban Catalyst could help you with your tax bill when it comes time to sell. Urban Catalyst is the premier qualified opportunity zone fund based in Silicon Valley. And if you meet investors' qualifications and invest in a qualified opportunity zone fund, you could potentially get big tax breaks. Here's how it works. When you go to sell your stock, you will likely generate a large capital gains tax bill, which means Uncle Sam may want to take a large chunk of it. If you're not keen on sending all that money to the U.S. Treasury, Opportunity Zone funds like Urban Catalyst can help you shield those gains. And Urban Catalyst isn't just any Opportunity Zone fund. Forbes magazine and the Sorensen Impact Center ranked Urban Catalyst one of the top 20 OZ funds in the country. Don't wait too long. If you invest before the end of this year, you may not only defer capital gains taxes, but you also may be able to reduce your capital gains by 10%. And as an added incentive, if you hold your investment for 10 years, you will likely not have to pay any federal taxes at all on those gains. And it's not just stock sales. Capital gains from real estate sales, selling your business, or even a big crypto sale, these types of capital gains can all get potentially favorable tax treatment by investing in an Opportunity Zone fund. Urban Catalyst focuses on development in downtown San Jose, an area prime for growth and revitalization. You can learn more about the fund and the numerous development projects underway by visiting urbancatalyst.com/millionacres. But keep an eye on your calendar. You only have 180 days after your capital gains event to invest in an Opportunity Zone program. So visit urbancatalyst.com/millionacres today.
I'm back with Matt Faircloth. We're talking about how to raise private capital. So let's talk about the investor experience. So how do you determine how much money you're going to need as the deal provider? And when you're starting to think about how you ask, do you look at your existing pool of investors? Do you break it up? How do you kind of go about that process?
I'll give you two brief answers. There's how we do it now as the DeRosa Group, but we've raised, we've been doing this for a bit, right? We're about to launch our 14th real estate syndication, so we've kind of got our model down. But I'll speak to beginning folks that want to start raising capital that want to or did read my book and are looking to do their first, second deal, and then we'll talk about how you end up doing it in the long game, right? So in the beginning, you have to budget for three different things: how much money you need to buy the deal, how much money you need to fix up the deal, and operating cash, aka just in case money, aka money on the shelf that you can use as you need it. And that's the biggest mistake that a lot of real estate operators do, is they don't put enough money on the shelf for just in case. I hate to say this, I hate this term, but rainy day money, because it's like, well, what if it's not raining? Well, you might still need it, right? So it's like, but it's just that capital that sits there that maybe if you're a little short one month to bridge your expenses or something like that, you're going to need it. And sometimes you have to advance construction and things like that to contractors, all that stuff. So we tend to I would add up that math of purchase, construction, and capital reserves, right? Add those three numbers up. That's how much money you need. Now, the beginning investor, those who are looking for equity or debt for their deals, what they need to do is they need to start talking about real estate investing with their base before they have a deal, right? And I even recommend, and this is, I'm dating myself a little bit because this is getting a little passe, but send out a newsletter. And now everybody's got a newsletter, right? I mean, I probably get 3 a day, right, from everybody. But you start to, you maybe do Facebook posts or do whatever it is you want to do to engage your base. We still do newsletters in that, but we've built up a really good following around it. So whatever you do to engage your people, your network that you have built a interest level around real estate investing for, then you want to let them know, hey, listen, I might be coming into a deal here. And if I do, are you interested? Oh yeah, sure. I'd love to, whatever. And this should not be the first conversation you've had with these people. These are people whose ears perked up when you talked about real estate investing, or people that you happen to know have money in the three places that I talk about in raising private capital, which is cash, IRA accounts, or real estate equity, right? And raising private capital talks about exactly what to look for, how to find those three buckets of money. So make your network reach outs and then marry the two together. I need $75,000. I'm going to break it down into bite-sized chunks of $25K a piece. I'm going to have 3 investors at $25K a piece, and I'm going to, bring those in. So that's how you would break down a small deal. The larger deals tend to go the same way, except for it gets a little more complex when it comes to how much capital you need, because there's maybe some fees that you want to budget for in there. The closing costs can become significant, where closing costs on a small little duplex may become maybe like a rounding error, but a closing cost on a $10 million apartment building can be very significant. So that is something you have to, put in your budget, if you will. Then we just email it out to our base, and for a legal syndication, you have to set a minimum investment. And so that just gets set there. You do the algebra to see how many investors you need to make the deal go down, and you're off to the races from there.
So do you have a team of lawyers that look at each sort of your offering and the syndication before you set it up? And is it possible, do you have to have a fresh look at it, a lawyer look at each individual one, or do you kind of set up a template?
We do. The template we have is our offering memorandum, meaning like our deal that says, hey, here's the deal, this is the financials, this is why it is, because the offering tends to answer around the same questions, which is, why should I invest in real estate? Why should I invest with you? And why should I invest in Lexington, Kentucky? And why should I invest in that property right there? So they tend to answer the same questions over and over and over again. So we use a template for that. Now, for the syndication legal stuff, the operating agreement, the private placement memorandum, the subscription agreement, and jazz, we typically hire an attorney every deal, because you kind of want that attorney's, insurance and their that you want them bound to to each agreement that you write and that you launch. So you've at least got an attorney's license and their street cred standing behind each deal that you do, and that. So we tend to hire an attorney every time that we do an offering, and it's likely a template they pulled off of their shelf, but it's really I just want their eyes, and I want to pass the liability of potential issues over to have their at least joining us in that. Because they know what they're doing with regards to the law around syndications. The law does change; it's changing regularly around what you can and can't do on these things.
You brought up something interesting there I want to zero in on too, which is E&O insurance, errors and omissions. Anyone who's done real estate or anything regarding contracts is probably familiar with that term. But I think that's an important thing that you mentioned right there, is that, if there is a problem in the contract, you've got that extra level of protection by having, the attorney directly tied to that.
Mm-hmm. Yeah. If they misspelled something or spoke out of turn in their agreement or whatever, they can call that an error, and they have those insurance. And your company should have a GL, a general liability insurance. And once you get some cash flow coming in, you can afford, insurance, you can afford, directors and officers insurance, D&O insurance, and those kinds of things. So this insurance is just in case, just so you can sleep a little better at night, kind of things. In that, but it's also good to have an attorney that knows the rules better than you do, write these things. As tempting as it is to just go buy one of these operating agreements off the internet for $250, it's better to pay an attorney that can customize it for you.
Yeah, absolutely. So as you're looking at your different deals, do you kind of match up the deals with the investors? Do you know investors who are particularly interested in a certain market, like you mentioned, like Lexington, Kentucky? Do you have some people who are like, I only want to do multifamily, or I only want to do single family, or I only want to do fix and flips? Or do you kind of have to play that game of matching people up a little bit?
Yeah, when we used to do a lot of different things, it was that. It's like, well, we got two fix and flip projects. We're also doing this multifamily deal or whatever. But Deidre, it really goes back to returns and time, right? If they're interested in investing with the operator, if they have researched the DeRosa Group, my company, and they see that we are of integrity and they like our company mission and they're in line with our core values and everything like that, then they just want to know what we're up to. And so what I find that really governs people's decisions are the perceived risk, and the rate of return that you're going to pay, make sure it meets their investment goals. But most importantly, above everything else, is time. When am I going to get my money back? How soon are you going to start cash flowing me? Because we've done deals that had a 10-year time horizon, right? 10 years is a long time. But sometimes it takes that long for deals to come to fruition. In this very changing economy, we've done everything that's got we're playing the long game on everything right now. And like nothing is we're projecting short returns. We're looking at 10-year returns for most of our stuff now, because we think that it's going to be better to stay in the game for longer than shorter these days. But we do offer, some people want short returns. And so we also offer that. If like, okay, great. You want your money back in 2 years? I can do that. You want your money back in 10 years? You kind of want to set it and forget it. I can do that too. So we find time to be the biggest governor of people's decisions. Once they've decided, the risk factors for apartment buildings meet what their risk profile is, then it really goes back to time.
Interesting. So when you're meeting someone who's new, maybe it's a referral from someone else you've already worked with, what's that first meeting like? How do you kind of show them what you do without being in like full kind of listing presentation mode? What does that look like?
We've built a pretty good social presence for ourselves. And so I'm lucky enough to have, gotten onto YouTube in the early years of like when YouTube was a lot easier to build a presence on and build a following on. So we've got a pretty good YouTube following now as the DeRosa Group in that. So it's fairly easy for people to get to know us, and thanks to my book and Bigger Pockets and Google and those kinds of things, it's very easy to research our company. I rarely have to begin from the beginning with regards to what the DeRosa Group's all about, when we stand for. They typically can research that before they come in, which is why I think it's so important for rising real estate investors to get themselves some sort of a presence online, a website, of course, but create some content, get on some podcasts, or have your own podcast, whatever you want to do, but create some media that people can read before they talk to you, because that begins the conversation before you even have to talk to these folks. But if they haven't, then I remind them what our core values are, what we stand for, how long we've been doing this, the markets that we're invested in, what we will and won't do. I give them some examples, those kinds of things.
Well, I like that you, in the book, you talked about videos, photos, all of that stuff as investor communication as well. One of the things I've seen more and more is that investors, cash providers, they want to see videos of in progress stuff. They want to see that stuff on Instagram. I follow a lot of real estate investors now who are showing, what it looks like when the place is gutted and things like that. How are you using photos and videos in your conversations with investors?
We use it to teach. And we use it to teach little hacks, right? Like we redid a kitchen in one of our rentals for literally a couple of $1,000s, and redid the whole kitchen with appliances and everything. And I was like, man, this is cool. Who thought you could, make a kitchen look like, go from here to here, before, after, for that amount of money. And so we just did a before and after, like this is this, skunky kitchen right here. And look at this swanky kitchen with the, with the backsplash and the new tops and da. So we've done, we've shown our hacks that we've things that we've figured out and ways that we've navigated. So we use social videos, those kinds of things, to say, hey, come shake. Can you believe this? And I'm just as amazed as they are in the video. I'm like, look at that. Can you believe those cabinets? I'll also talk about things I wished I had known earlier. I did one video that did really well. I just talked about my favorite kinds of flooring in rental, and I ranked them from top to bottom with hardwood floor that I can refinish being my favorite kind of flooring, and my least favorite ever that I wish was never in any of our rental properties ever is carpet. And I ranked them all in between in that. And I shot a video just teaching. So almost 90% of the time we just teach what we do, but also we just try and teach people like, hey, listen, this is what it really is like to be a full-time investor. This is the day in the life where we just show, hey, this is you want to see what life looks like. We're not just sitting on the beach drinking Mai Tais. This is really the scrappy sleeves up, life of a real estate investor. Because I think it's probably one of the most misconceived professions out there.
I think people love that. It's the HGTV effect. People love seeing, everything gutted and the problems with, the worse the basement is, the sort of like more interesting it is. Although not for the investor, because that can be awful. So let's talk about some of the tough stuff, because I don't think there's ever an investment that goes 100% smoothly exactly the way that we think it's going to. There's always something. So how do you kind of communicate that when you're dealing with investors and when they panic and things like that?
There's so many variables, I mean, like we got one. I'm trying to sell an apartment building right now, and the closings have been delayed 3 times because of like the first was this variable, and of course every vendor in the whole wide world points to COVID right now. It's like, oh well, because COVID, we're delayed. Like, you're delayed. Why? You can't do the appraisal for the next 2 weeks because of COVID? Really? Tell me. Can you diagram that for me? But that was their excuse, and that's their story, and they're sticking to it, right? And so the time is probably the thing that variable plays in the most. And then there's always the unexpected, aside from like just crazy tenant issues that just show up. And I could floor you with all the stuff that we've had happen in our years from a tenant landlord experience standpoint, or just miscommunications, or just things that just make you scratch your head or shake your head. Like, really that happened? There's those kinds of things and I just think that, sometimes it's, hey guys, you just can't make this stuff up. You're not going to believe what just happened, but let me explain it to you, and I think that the best thing you can do, Deidre, is coming in is you temper expectations on the way in. It is the most under-promise and over-deliver industry I've ever been in. And I've been in a few, or friends that I have in other industries. It is, you have to under-promise and over-deliver, and over-deliver, because that under-promising is your hedge for any number of variables that are going to happen in the world. And I've seen a lot of real estate investors, unfortunately, overpromise, and then the world delivers them curveballs, and then it's like, oh, you're not going to make this 22% investment you thought, return on investment that I told you were going to make. It's only going to be 14, and 14 is still really good, but because I told you were going to make 22, I now look like a schmuck because I told you something that didn't happen. So, I think it's way better to underpromise, and then you can do your best and account for all the many, many curveballs this business seems to love to throw us.
Yeah, I think you're absolutely right. Someone would be absolutely psyched about 14% unless you told them 22, and then not so much.
I told them, hey, if the whole world falls apart and Chicken Little happens, then likely it'll be 10%. And then they're ecstatic that not all the bad things happen, and we made 14.
Exactly. That is a very good psychological technique there. So one of the things you talk about in the book is that, when the deal goes perfectly, the investor gets back their money, everybody's happy. But a lot of times, as we just mentioned, things don't go as planned. How do you kind of make that up sometimes, and how do you get them to invest in the next deal?
I make sure they know that I'm doing my best. And I communicate a lot, and I make sure that they know that I'm willing to fall on my sword. I've done fix and flips that got so far south you couldn't see where you couldn't see the original plan from where we were standing, because things just got so squirrely. It just went the wrong way. But we were willing to, in those circumstances, put in our own capital, or write checks out of our own pocket, or forego our entire return as investor, as the owner. And that to cover investors' returns. And I'm proud to say we have never lost investor principal. We have not returned what we thought we were going to on deals, because hey, that's the variable roulette wheel comes up here, right? So, because a lot of things do and can and do happen in this business, even with best expectations and best efforts. But I will say that we are happy to forego our side to get investors whole, and I can tell you crazy stories about how money got stolen or anything like that, or how things happened or whatnot that really curveballed what we thought were going to happen. And we just covered investors with our side and said, you know what, we're gonna let you guys take the proceeds on this one, so you can at least get a reasonable return on your money. So that's how we bridge it: over communicate and be willing to put our investors first.
So you mentioned earlier that you're doing both loan deals and equity deals. What does that look like, and why are you working with both of those structures?
A loan is perceived to be a little more secure because it's got collateral, right? Loans have collateral, and loans have a predictable fixed rate of return, and equity gets upside. And so equity could go to zero, but it also could go to a bajillion, right? And so but a loan is perceived to be a nice, more fixed rate level of return. Can't go up, can't go down on your rate of return kind of thing. And you also got this nice collateral, meaning like a property with your lien on it. So from an investor perspective, there are things that check both investors' risk profile boxes. So we don't do as many loans anymore. We do just more fixed rate, short term stuff, but it's still an equity position. But I spoke out of turn because we are doing we're doing a blended private equity fund that invests in a lot of different things. So I've got a blended private equity fund that invests in hard money loans and it invests in short term lending projects and things like that. So we do provide loans. We don't. We're not borrowing money directly from investors anymore, but we do put investors into lending projects that we are involved in also, if that makes sense.
Interesting. Okay, so now you're making funds where it's not just this money for this deal, it's actually the money keeps going into different deals?
Mm-hmm. Well, so we have a blend. I found, and this is one of these things, I've been doing this for a little bit, I found that there are things that investors like about investing that they can't get through a syndication. Those things are liquidity, meaning like I can't call you up, Matt, and say, hey, I want my money back at some point. And in a syndication, it's like, well, geez, call me again in 5 years when we're done the business plan, and that's when I can get you your money back. Because once you're in, you're in. And sometimes turning around these apartment buildings can be like turning around, a sea container. It takes a while, to get these things repositioned. And so getting capital back is very hard to do. That's number one. Number two, you can't compound interest. And so, because the syndication is a limited thing, that there's only but so much equity in the syndication. So people can't buy more of it once it's closed down. And that's what compounding is. It's buying more and more equity. And the thing is, I get returns instead of you writing me a check. It's me taking that check and me rolling it back into the fund and compounding my returns. And obviously diversification. If I invest in a multifamily syndication that's in Miami, Florida, I am exposed to Miami, Florida. Even if it's a fund that's in a few different multifamily projects, that's what a lot of people do, is they offer like, well, I've got this fund and it's going to invest in deals in Miami and in Orlando, but you're still in multifamily real estate. So it's rare to find a fund that has true diversification. So we decided to start a fund that has liquidity. You want your money back? We'll give it to you. That has compounding interest. You want to recycle those returns you're getting back in and buy more capital and enjoy exponential growth of your money? We can give that to you. And we're also investing a bit in syndications and a bit in multifamily, but also in loans and in distressed assets and in really fun stuff like tax liens, distressed mortgages, those kinds of things. So we're taking the money and truly diversifying it into real other asset classes. And that's probably the thing I'm the most excited about is that fund. Because it really gives something completely different than anybody else out there is offering. But it's really what investors want, is to get exposure to real estate on a couple of different fronts, but also be able to get their capital back and let it grow.
Interesting. So what are the rules on that? Do you have to be an accredited investor to be part of something like that?
For that one, it is, because we're just getting started with it, but that is not required by the SEC. It's just that accredited allows the syndicator to solicit. And that means they can go shout it from the mountaintop or, put it on Facebook. I'm starting a fund and you should invest in my fund, right? And so that's soliciting, and that's reaching out to people they don't know and talking about, hey, I can make you this rate of return, in that. Now, we don't solicit mostly. We put a lot of our just stuff on YouTube, which is why we just educate. It's not solicitations. We have done what's called a 506C offering, which is for accredited only, and we have done solicitations that way. But we've also done 506B, which is to your existing network, and it allows you to do non-accredited as well. So the fund, because it's new and because we want to build it, we want to grow it, it's accredited only, but not because accredited's can invest in something that's as sophisticated, as complex as that. It's got nothing to do with that. It has to do with how I'm allowed to get the word out by the SEC.
So as we wrap up, I want to talk a little bit about your evolution as an investor, because we've talked all throughout this. It's clear that you started with like a house or two and some fix and flips, and now you're involved in some really complex and advanced different kinds of deals. What was that trajectory like?
So it is like sitting on a roller coaster, Deidre. Right. It's been quite a journey, but it's been great, and it's gone well. And I'm inspired, and I pinch myself almost every day. But the few things that I can say that we attribute it to is by always putting investors first, even on the small deals, and always asking for referrals, because people know people. Everybody knows people. Everybody's got a Rolodex. And I think a lot of people are looking for something different. They just don't know something different's out there to invest in. And so that's how we've grown. And also we've been willing to stretch ourselves to try on and learn new spaces and ask people that are involved in those spaces about how to do what they're doing. Like, we did not get started in apartment buildings. We got started in single family homes, and grew into multifamily over the years of investing. So that's been probably the most interesting journey, is the growth into larger and larger real estate. So, but I think it's just about stretching ourselves. And I would say that to anybody listening, that's really how you grow, is you just get this much outside your comfort zone, and commit to do right by people. And that's going to create exponential growth, probably beyond what you could imagine.
So in terms of the education, was that you reading books? Was it going to RIAs and things like that? Was there schooling involved? How did you get to understand everything to the place where you got comfortable saying, okay, I'm willing to go from a house to a multifamily dwelling? Because that's a big leap for a lot of people.
We didn't jump from just that. We went from like a house to small multi to a little bit bigger multi to a little bit bigger multi, a little bit bigger multi.
Smart.
But I always found that the most important thing you can do as you grow and expand is to find people that are a few steps down the road as either mentors. And it doesn't mean you got to get Sam Zell's cell phone number and call Sam Zell and ask him how to buy apartment buildings.
I wish.
Right, I know. So if somebody gets that, I'd love to talk to him. That's one of my bucket list, right? But that's not required to go talk to somebody that's all the way up that level. It's just somebody that's done a little bit more than you have in that. So that's yes, reading books. Yes, going to RIAs. Yes, going to a lot of courses and stuff like that. Formal education, I got my degree in engineering. I was an engineer in college and everything like that. I did get my real estate license back in the day, just because I thought that was a good way to learn the space. Required maybe, in that, I mean, I find not every real estate agent knows, what there is to know about the space. You have to go to school longer to cut hair than you do to become a real estate agent in this world. But it's one of those things that it was good for me at the time. So that was probably the only formal like classroom education that I did, aside from like courses, taught by experts, like, RIA level experts and stuff. So, but the biggest thing we did was to reach out and talk to people that were a few steps down the road and say, hey, can you introduce me to your lawyer? Can you introduce me to your CPA? And to get access to their team so I can make them my team too. And get their vendors, get their mortgage officer, see if they'll help me get access to some of their networks, so that I can build my network out and have people that are willing to take me under their wing, and maybe not harass them with questions all the time. But if I get myself into a bind, have somebody that I know I can call if I need something.
I love that. And, the engineer thing is so interesting. I've talked to so many successful investors that are engineers. I don't know what it is about engineering training that makes for a really good real estate investor, but
it's a left brain, right brain thing. I don't know.
Yeah.
It's an analytical. I can name, when I said it, I'm like, it reminded me of a lot of these syndicators I talked to just over the years and that are successful investors. That's been their background. And they all were like, yeah, I used to work for 3M and I was an engineer, but it's like I was an engineer somewhere. Then I read Rich Dad Poor Dad and here we are,
That is exactly the path that I've heard more than once. That's awesome. All right. Last question for you. What kinds of technology are you using to grow and maintain your business? Like, are you a CRM guy? What sort of tech is working for you?
We use ActiveCampaign. I'm an ActiveCampaignaholic. I love it. We used to use some other ones. I think ActiveCampaign's a good one. I use Slack to keep in touch with my team because text messages, email just get buried in the minutia, and just get kind of lost and all that. So Slack is a good team communications tech that we use. We use Smartsheets for accountability and for developing like dashboards for each piece of my real estate has a dashboard, so I can chart things out. And Smartsheets is a means to just look at the property dashboard to say, oh, we're here, and that. So those are some of the technology pieces that we use.
Awesome. Well, Matt, this was fantastic. You can learn more at DeRosaGroup.com. The book is Raising Private Capital. I really recommend it. It's a good, solid read. You can always email us at media@millionacres.com to share your thoughts. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discussed at Millionacres, or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.